que al menos ese shock de oferta no dañe la economía. Está con nosotros Terry Ewing, Head of Equities en Mediolanum International Funds Limited. Good morning, Terry. Good morning.
Good morning. Pleased to be in your show.
What's your equity? What's your outlook for equity markets for 2022?
So, good morning. As I said, we've seen very high returns in recent years in equity markets, and equity markets have been supported by a wide range of strong platforms of support. In particular, you've seen the Nasdaq 100 rise by about 300% over a 5-year period to the end of 2021 because of low interest rates, low inflation, robust earnings growth, improving margins, and a re-rating in the market. But so far this year, in sharp contrast to that, we've seen the worst start in 50 years to equity markets. So why has that happened? Well, we've seen some of these key elements of support pull back, such as we've seen disruption to supply chains from the rebound in the global economy from COVID. We've seen commodity prices move very sharply upwards. There's been resultant pressure on profit margins, and indeed the central banks are having to consider increasing interest rates at a fairly robust pace over the next couple of years. And all this has contributed to a derating in markets. Of course, we've had the tragic events in the Ukraine just in the last few weeks, which has added to that level of derating. We've analyzed over the last 30 years that when the world is faced with these geopolitical sudden shocks, equity markets tend to derate on average between 3 and 4 PE or price earnings ratio points. And in Europe, we're almost there already. Equity markets have been pulling back since October last year. So we've seen this sharp pullback as equity markets have responded to the changing circumstances that we've seen. And we think some of these concerns are now embedded into current prices. And some of these concerns will ease as we move in to the second half of the year. So we've had a poor start, but we think things will gradually pick up and improve later in the year to provide modest but acceptable returns for equity markets this year.
You see equity markets reacting to the current inflationary threats and the prospects to the tighter monetary policy.
Yeah, and you're right. We've seen inflation spike very much over the last 6 years. That's really in sharp contrast to the picture we've seen in the previous 15 to 20 years where inflation has been really very contained. We expect the Fed to raise interest rates by about 150 basis points over the next 12 to 18 months. And indeed, on top of that, we've seen very strong fiscal support measures from most Western governments aiming to try and protect the consumer during this tough period of the COVID pandemic. This has allowed the consumer savings rate to very much improve, and the consumer and corporate balance sheets are in a strong position. So as companies have been trying to push through price increases, they've had quite a bit of success, and as the consumers are willing to pay for these price rises. Now, this is all called into question the central bank's credibility given this new inflationary threat. But we think at Mediolanum that the central banks have done a reasonable job so far of articulating their intention to raise rates, and that those expectations have already been embedded in equity market outlook, so that the equity market is already looking for 5 or maybe even 6 interest rate rises. Now, we would differentiate between the inflationary pressure we're seeing in the US to that of Europe. Inflation has spiked to over 8% in the US, as measured by CPI. In Europe, it's over 5%. But there are some elements that are quite different between the two markets. Namely, the employment market in the States is very tight, and that's partly due to some technical factors, but also just the sheer strength of the rebound, the economic rebound post-COVID. So we've seen recently 11 million new job openings advertised in the US, and that is well ahead of the number of people looking for work. So there's a bidding war for talent. And that's been exacerbated by the US government's decision to mandate that any company bidding for a US government contract must pay a minimum wage of $15 an hour. Now that's up from $11 an hour. So you can see a very sharp increase at the low end of the labour force in terms of wage rates. And this is really pushed through right the way through to create a war for talent, a bidding war in the US employment market. Now, financial markets have reacted. Treasury yields have moved up fairly firmly over the last 12-month period. As I said, financial markets have embedded some of these expectations. But overall, we are still confident that the Federal Reserve will be successful in delivering a soft landing and managing this inflation impetus, partly because, of course, some of these inflationary pressures, such as second-hand car prices, are temporary. And as more of these temporary concerns disappear over the second half of this year, we think that the markets will become more comfortable that the Fed is going to engineer the soft landing.
We are seeing two key points about the economy. One of them is US dollar more stronger from the euro and yen. And for the other hand, we have a rise of energy and commodity prices. Is Europe in this scenario the worst area in the world that could be a performance in this moment?
That's a very good question. I think certainly with the war in Ukraine, there's a big shadow being cast over European equity markets at the moment. But if you just look further into the detail at where the pressures are, we see real pressure in fuel and food price inflation over the next 12 months. And sadly, we think this will impact emerging markets the worst. And tactically, for that reason, we would be looking to keep pretty low exposure to emerging markets over this time period, particularly those countries that are reliant on food and fuel imports.
On the other hand, we are seeing corporate profits growth in this beginning of the year, but could be sustainable during this 2022?
Yeah, and corporate profits, you're right, corporate profits have recovered very powerfully since the COVID pandemic lows of the second quarter in 2020. But that profit growth is slowing. I think earnings growth was about 15% in Europe last year, was around 40% in the US. We see that slowing to more of a high single-digit sustainable level for global equities this year. And we saw earnings momentum peak really in the second half of last year. In particular, growth stocks have suffered the most in this time period, partly as financial markets have been adjusting to a higher level of interest rates. And that, of course, puts a higher discount rate on the future earnings of growth companies. So they've been most exposed to this period of higher inflationary pressures and the resultant interest rate increase. So we expect companies that ultimately we think order books are in good position for the global economy. We think PMIs are still strong. We think that there's decent growth within the global economy, and earnings growth will be solid for this year. So there are key supports for equities from here and key supports for profits, but certainly they're under more pressure than they have been in recent years.
Thank you very much, Terry Ewing, Head of Equities at Mediolanum International Funds Limited. Good day, good business, Terry.
Good day. Thank you.
Thank you. 9:33 de la mañana, mirando a una de las claves fundamentales que están